in crypto, there's very much a meta around, you use the revenues of the protocol to just buy back tokens. However, we're all startups. And so often the best use of capital is actually to reinvest in the growth of the business. And so I don't know that you want to be so constrained there. Like ultimately, if I could invest, let's say it was, it's 25%. So roughly, what's that, 7.5 million of 30. If I could reinvest that 7.5 to produce even more revenue in future, I think that's a good use of the revenues of the business. But we want to give a nod to token holders and to long-term community members, and so we want to show that we have the revenues to do sustained buybacks, and so that's why we put that into the governance proposal. But if you fast forward, if we hit 100 mil revenue this year, which is the target, then that would be about 25 million in annualized buybacks and purchases for the reserve.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features Sid Powell from Maple. So we're very excited to tell you about a new series we're launching called Revenue Meta.
Yeah, so as long as I've been in crypto, I think I've been fundamentals driven, but that hasn't been at all what's been driving prices in crypto for that amount of time. So we're seeing the tide turning in DeFi especially, and we wanted to just spotlight teams putting fundamentals ahead of narratives, and shine a light on teams that we think are kind of trailblazing. So teams that are, creating sustainable DeFi businesses, generating real cash flows, and accruing that value back to token holders. We're seeing this finally start to emerge. And again, we just want to have conversations with these founders and talk about their goals, kind of short-term, long-term, where they're heading, and how they're going to achieve these goals.
And per usual, I think our content starts with our own genuine interests. What are we researching? What are we trying to learn about in case we would invest in it? So we're really excited to use the access we have to the best founders in DeFi to help you and ourselves learn more about how they are generating these revenues for DeFi protocols.
I think you kind of nailed it. I mean, I think the roadmap is, hey, what are tokens that we would want to hold ourselves? And let's have a conversation with that founder and make a decision for ourselves through this call. If this is something that looks worth buying.
So just a few details before we get started. One, we want to remind you that nothing said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice. 2, we'd love to get your feedback on the new episode format. Let us know what you think. You can comment on Spotify, YouTube, or tweet at us. 3rd, if you'd like to see a specific founder on Revenue Meta, please tweet at us, DM us, let us know. And then before we get started, the reason we're able to be creative like this and start new show formats is because of the sponsors that make the Edge podcast and the Edge newsletter possible. So let's hear a quick word from those sponsors like Toros Finance. Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. Grow wealth exponentially. With Toros leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With Toros, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. Toros reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. Toros Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
So Sid, we wanted to have you on today. This is kind of a first in hopefully a new series where DeFi Dad and I kind of look into tokens, protocols that are actually generating revenue. There's not a ton, unfortunately, but we wanted to start off with you and Maple. You put together an excellent year-end report on what you were going to do in 2026, and that's a lot of stuff we want to dive into, but we also just want to ask some simple questions. So I'm going to just start out with our first one. We want you to walk us through how Maple generates revenue for the protocol. Just simple as that.
Yeah, for sure. Happy to cover that one. So as users of Maple know, we are primarily an over-collateralized lender. So we bill ourselves as an asset manager on chain, but focusing on the over-collateralized lending. So we charge borrowers an interest rate, which they pay to the protocol. And then of that interest rate, we take a portion as protocol revenue, and then we pass the remainder on to the folks who we call lenders, so people who are providing capital on the platform. So overall cash flows is the full borrow interest. Let's say that was 6.5%, and then we take a spread of that. It can be anywhere from 65 to say 100 or 125 basis points. It kind of depends on how high the interest rates are on the market. As they go higher, we can take a little bit more. As they contract and it gets more competitive, we take a little bit less, because we always want to keep our yields that we pay out to lenders competitive and best in breed among DeFi protocols. So you'll see protocols will talk about their overall fees or revenue, but what we think of as the protocol revenue is that portion that comes out of the interest, and that's what goes back to the protocol, and that's what can be used for things like token buybacks and for growth.
When you generate those fees or revenue, what happens to that money? Can you just break that down for folks who are, wanting to better understand how does, the business of the Maple protocol actually work?
Yeah, so when those fees come in, they're collected by smart contracts or other wallets. Sometimes we earn a little bit of fee revenue on the collateral that might be posted by a borrower, if it's a proof of stake token, let's say Solana or Ethereum. So we aggregate that revenue, and then that goes to the Maple treasury. And then from there, it can be used to pay, wages and staffing costs of things that we need to keep the lights on. Then some of it can be used for buybacks or what we would call contributions to the Syrup Strategic Fund. So we put out a Maple improvement proposal late last year, and this said we would use 25% of our revenues for either buybacks or purchasing assets for the reserve. So we gave ourselves the flexibility to purchase Bitcoin if we wanted here, but it can also be used if we can get a good price on it to buy back Syrup tokens, and then that all ends up owned by the treasury. So that treasury funding is used for everything. We don't have separate pockets of revenue, and I think that's important. We don't have an equity entity that earns revenue over here and is separate from the DAO revenue. We treat it all as being one pot of revenue for the entire Maple ecosystem that's used for staffing costs, operating expenses, and token buybacks, which I know people care a lot about. So in order to calculate Maple's revenue, you should look at our deposit base. We published this on June. It's also published on DeFi Llama, but we have Maple's overall assets under management equals the loans we have outstanding, cash that hasn't yet been deployed, as well as the collateral from the loans. So if somebody borrows dollars from us and they post Bitcoin, that goes into the overall assets under management number. But the number that determines our revenue is really the size of deposits in the loan book. So if you look on the Dune dashboard we publish on DeFi Llama, if you go to that and then you roughly approximate, at the moment, it sort of hovers around 65 basis points or 0.65%. But that's effectively our annual take rate in revenue. And in good markets, that goes up a bit. And if we get our cost of capital down, which is the amount we have to pay out, then that also goes up a little bit.
I got a quick one. So we'll have hopefully flashed that Dune dashboard up. That's an infamous one. I think a lot of people were tracking around the industry, myself included. But I want to go back to kind of last year, how that Dune dashboard ended. So I think, correct me if I'm wrong, I think you finished at the last month of the year, I think you brought in around 2.49 million revenue. And that ARR kind of tracks to like roughly 30 million, right? So maybe taking, so let's just say we use that finish to last year. If we were to extrapolate out, so 25% of that 30 million would go towards token buybacks, correct?
It would go to contributions to the reserve. So it can buy back the Syrup token. It could also be used for, say, purchasing Bitcoin, but it's to grow the strategic reserve of the Maple protocol. So we didn't want to be so restricted that it could only be used to buy back tokens. I view that as kind of, it's a quasi-dividend in a way, similar to what happens in equity markets. However, if the token were overpriced, we might want to purchase something else like Bitcoin to strengthen the balance sheet reserve. I think in crypto, there's very much a meta around, you use the revenues of the protocol to just buy back tokens. However, we're all startups, and so often the best use of capital is actually to reinvest in the growth of the business. And so I don't know that you want to be so constrained there. Like ultimately, if I could invest, let's say it was, it's 25%, so roughly, what's that, 7.5 million of 30. If I could reinvest that 7.5 to produce even more revenue in future, I think that's a good use of the revenues of the business. But we want to give a nod to token holders and to long-term community members, and so we want to show that we have the revenues to do sustained buybacks, and so that's why we put that into the governance proposal. But if you fast forward, if we hit 100 mil revenue this year, which is the target, then that would be about 25 million in annualized buybacks and purchases for the reserve.
Sid, how big does the book of loans need to be by your estimate in order to achieve that 100 million ARR?
I think it's got to get, based on our rough take rate, it's got to get to somewhere between 10 and 14 billion in terms of size. One of our goals this year will be to get our cost of capital down, and so we're doing things like exploring partnerships with traditional finance investors and asset managers who might be able to allocate capital to us at a lower rate than what we currently get it. And so if we can expand that take rate from kind of where we sit today, which sort of hovers around 65 to 70 basis points, then it would be in that kind of 10 to 14 billion range. So if you look at where we sit today, total deposits are low twos. So you're talking about a five-ish X growth, but it would be about a 4X growth on the current revenues that we do.
I want to get back into things that you're going to do to achieve that number, but I just want to go back to something just to make sure I have it correct in my head. So we talked about that 25% that goes to kind of treasury, potentially buybacks. What the other 75%? Where is that going? Of the revenues?
Well, ultimately, it will go to the treasury. So if you look, we will pay staffing costs, but it doesn't go somewhere else. It doesn't leave the protocol. It just builds the balance sheet of the treasury. So think of it as, Warren Buffett builds up cash and then he can go elephant hunting during downturns. We want to have a strong balance sheet so that we don't have to be out there raising capital in a bear market. We want to have 24 plus months of runway to keep the lights on, but we want to have a cash reserve for unforeseen events, whether we have a problem with a borrower or something on the credit front, and we will have the balance sheet there to withstand that. Or perhaps it could be for a strategic growth opportunity. We might make an acquisition, or maybe like acquire a team, or increasingly you find that as we talk with some of these TradFi players, they might explore a strategic facility with us, but then we have to put up what's called first loss capital, which means effectively skin in the game at the bottom of the deal. And having a strong balance sheet enables us to do that. So it remains within the protocol treasury to serve, for the benefit of token holders and for the growth of the protocol. It doesn't just get paid out as a dividend to somebody.
By the way, is there any dashboard for being able to track all that information in terms of the money that the 75% that ultimately ends up in the treasury and can be used for a number of different matters?
We do have treasury wallets disclosed. I think we want to get better at this. One of the things I look to is I really like the Sky ecosystem dashboards and some of the stars within there, whether it's Spark or some of these others. What we want to get to, we've hired data analysts recently, is we want to start to have public-facing dashboards that show here's the balance sheet strength of Maple, here's the revenue coming in, and and here's the war chest that we have to grow and take Maple to the number one spot in terms of institutional lenders.
I saw Vance from Framework. He tweeted out something like the entire loan book was $200 million in January 2025. Last week, Maple issued a single shot $500 million loan. So, we see that you're scaling. I'm wondering, do you need to hire that many more people in order to continue to grow?
Well, we're actually only at 37 people overall. So I would say we're still pretty lean, and we probably added about 15, maybe 15 sort of total gross over 2025, and something closer to 10 net headcount. So if you look, our portfolio more than 10x'd over 2025, and we only added kind of like a net headcount of close to 10. This year, we're ballparking, we might add another, let's say, 7-ish people. So we're still going to be relatively lean when you compare ourselves to the AUM that we have. And nowadays, we're able to get more leverage and more mileage out of each person because of AI. So we're starting to automate our workflows, whether it's loan settlement. I get a dashboard every morning sent to my inbox, which has an AI readout of our overall portfolio risk and collateralization levels across every loan. So we use AI for monitoring there. And also, our business is scalable because we're not a retail lender. So I can easily take a large borrower who does 100 million with us, and we could do 400 or 500 million with them. And, that doesn't really require more headcount. You're just upsizing the share that you have with of wallet with your clients. So I think our business is very scalable. You only have to look to Tether, who's the largest lender in the space at around 18 billion, and they run a very lean headcount overall. So I think that shows that it can be done. You can get to that size without significantly increasing your headcount.
I saw the stuff just over Christmas and New Year's too, and I was like, man, these guys are just like trucking along during the absolute quiet doldrum period when, I'm just getting fat and drinking too much. But yeah, amazing. Actually, where I was going to go is, since we got you on, Sid, I heard from what I think might be a reliable source, but you can justify this and just ballparks here. But I heard that for every 1 billion in circulation added for syrupUSDC or syrupUSDT, it adds roughly 15 million in ARR to Maple. Is that napkin math even remotely possibly true, or does that track at all?
The Mantle Global Hackathon is a 3-month competition inviting developers and founders to design and deploy scalable Web3 and RWA products on Mantle's modular Ethereum L2, built for high performance, low fees, and full EVM compatibility. With $150,000 in prizes and a $30,000 grand prize, now is the time to build. Register by December 31st, 2025. Submissions are due by January 15th, 2026. To learn more, go to mantle.to/hackathon/U4U, and don't forget to follow Mantle_official on X.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are 2 key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Decibel is the new sound of trading, a fully on-chain trading engine supporting spot markets, perps, and yield to trade global markets. Enjoy trustless execution and sub-penny transaction fees. Join the future of trading at Decibel.trade and access the Decibel testnet today.
It'd be a little bit smaller. So if you look at that, like saying 1 billion of syrupUSDC or syrupUSDT, that would be about 150 basis points. We've been as high as that before, but I would say that's pretty punchy take rate. Typically, maybe it's going to be in somewhere between the 7 to 12 range.
Okay.
And it kind of varies depending on market conditions. Let's say normalized somewhere close to 10. But the point you're making over Christmas, so I think that's something worth highlighting. We get those deals because Maple's now at the scale where we can write a $500 billion loan comfortably from the assets on the platform. And we get the call because we're able to turn around the deals the quickest. So we're open for business over Christmas. We had that deal came through. We were able to settle it, I think, 1 or 2 days later after the inquiry came through. And then we had another one for 50 to 100 mil that we settled, next day from the inquiry. And by being responsive, by turning around these deals quickly, we get the first phone call when somebody wants to borrow nowadays, particularly at size. And I would say our cost of capital is pretty competitive versus the other large lenders. We may even be the cheapest among the top 4 global institutional lenders. So, Tether, Galaxy, Nexo. But we're certainly, we certainly aim to be the quickest off the mark when we get the call.
We just noticed a post right before we hopped on. Someone had tweeted out that Syrup outperformed ETH and Bitcoin in 2025. That kind of caught me by surprise because 2025 was, I think, a great year for the industry, but the price didn't track to where our expectations were. I think it's indicative of DeFi repricing the way we all want it to. What does this mean for you and the team in terms of operating with more clarity, more of an ally in at least U.S. regulation? You lived through the era of Gary Gensler. You started the protocol, I think, at a much darker time. I'm just wondering, what is it like to operate nowadays? What's changed?
It's a good question. I think, a number of things. So I'd say in terms of the client set, we can now, we now regularly speak with TradFi players because they are more open to working with DeFi protocols given the change in regulatory outlook and the friendliness of the regulators towards, innovation and innovative sectors. So I'd say, just being able to have those conversations and treat them as potential clients, whereas during the Gensler era, they never would have taken calls with us. I think that's the first thing. I speak with regulators and with folks, who might be staffers of some of the people drafting this legislation. So there is a very much a two-way dialogue in terms of how the legislation will look and how the rulemaking will look, which I think was absent, over the previous 4 years before the new administration. Before it was very much a one-way traffic of, this is how it will be, whereas now it's more collaborative. They're seeking to take feedback from the industry of what will help create jobs in the US, what will help protect consumers, what can teams do proactively to be part of the conversation and try and create a product that's ultimately, good for investors and consumers in the US. And I think DeFi has the most product market fit of anything else in crypto. I'll lump stablecoins into DeFi, so DeFi and stablecoins. And it's also much more encouraging for attracting talent. Like now, you have people who were at fintechs who, are applying for jobs at crypto companies. Whereas before, there were a lot of people worried, if I join a DeFi team, am I painting a target on my back and hurting my future career prospects? So I think all of those things are now much more positive. Talent, collaborative dialogue with the regulators, and, TradFi, traditional Wall Street firms who are now willing to engage and explore partnerships.
Yeah, couldn't agree more with all of that. Okay, I want to go back to something we talked about a little bit earlier here. This jump to 30 million ARR to 100 million. How are you going to do it as far as what new business lines need to happen? Or is it just growth in the original sectors that you're already kind of spearheading? Yeah, maybe walk us through how you achieve that.
I'd be remiss if I didn't talk about some of the new products and improvements to the technology stack we want to introduce. So we bill ourselves as an on-chain asset manager. Our core business is and remains the over-collateralized lending. We've looked at adding what you might call, trading strategies to make use of idle funds that we have. So this could just be, arbitrage, things like that. That's probably going to be a smaller part of our business for the time being, but it's something that we're working on, and everything that ends up big starts small. And then what we want to do is we want to make our technology stack more modular. So right now you can go into our permissioned high yield product, or you can go into syrupUSDT or syrupUSDT, and each of these is more of a DeFi distributed product. You can use it in Aave or Pendle or Morpho or Euler, or take it to Solana and use it on Camino or Jupiter. So what we're finding is that as we start to approach more of these fintech and neobank type partners, whether it's, if we wanted to do an earn program with, say, a Robinhood or a Revolut or a Lemon in Latin America, what we need is to offer them kind of very specific products. And so we want to make our stack modular. So, you can be somebody curating one of those earn programs, and you can connect to Maple's Bitcoin over collateralized loans, which is the lowest risk thing we do. Or if you want to get a bit punchier, you can take altcoin collateralized loans, pick up a higher yield. So what it will look like is we'll have each of these strategies underlying the platform, and then you can choose to go into one of these products if you're say an earn program, or you can go into a composite of them. So we would still have syrupUSDC and syrupUSDT that could be a mix of these products. So we think that will open up more customers to us, and I've hinted at it in that answer, but we really want to go after fintechs and neobank type relationships to get to that 10 to 14 billion in deposits that I mentioned, as well as we want to grow our market share among the over collateralized institutional lenders. So we're fourth. We came from outside the top 10 before, like at the start of 2025, we would have been outside the top 10. Now we're number 4. We want to steadily get towards the number 1 spot. And I think a big key to that is going to be establishing some of these traditional finance partnerships. So we're talking with asset managers, credit funds, banks around trying to get ourselves a wholesale facility. And what we want to do that is explore things like securitization structures so that we can get a facility rated by an S&P or a Moody's or a Fitch. And then once you get it rated, you can get traditional investors in, because they're all fixed income investors are very often restricted by their mandate, which requires them to do, only investment grade assets. And so if we can get a Bitcoin backed warehouse or Bitcoin backed loan warehouse rated, then we have an enormous universe of investors that we can go and talk to. So that'll bring TradFi capital in, we'll bring fintech and neobank capital in, and then we'll continue expanding our partnerships with Aave and Sky, our DeFi, our DeFi relationships, because we still think that, DeFi has a long way to grow, particularly in a time where, Bitcoin and the market might trade sideways. Everybody wants yield when they don't think Bitcoin's going to rip 30% over the next month.
And given that you specialize in Bitcoin-backed loans in size, there's very few venues folks can turn to, very few players they can turn to that are building on chain in the way you are, which really only matters because you're more capital efficient and you have all sorts of other advantages that I think the players in the legacy world just don't have at their disposal. Before we let you go, just a reminder, so the only way to get exposure to all the success that you've talked about here with Maple is through the Syrup token, right? There's no labs entity, no hidden equity, just Syrup.
Yeah, that's right. We have a labs entity, but the labs entity never raised capital and doesn't make a profit. So it's a pure service provider, but it's one token for the entire ecosystem. There is no equity entity that's making profits that has VC investment. Any VC who has exposure to Maple is through the Syrup token, and all revenues, all growth of the business we see as being tied to the Syrup token. And everyone on the team, is a Syrup token holder. So we put the token holders first in terms of our ecosystem and the growth of what we do. One other thing I was gonna add is the way we think about it is you effectively have earnings or free cash flow per token. If you go and dilute and print a bunch of tokens, it reduces that. And so your goal is to grow, either grow the top line earnings, and that's where we see reinvestment in the growth of the business, or you reduce the denominator through buybacks. But whether you should overweight buybacks or reinvestment in the growth of the business depends on the return on investment of that. And we see that Maple has a ton of growth ahead of it. That's why we don't lean as much on buybacks at the moment. We're more focused on reinvesting in the growth of the business.
Sid, this was awesome. Thanks so much for your time. I think you ran through all the stuff that I want to know and learn about right now. So hopefully it's valuable for listeners. But yeah, man, appreciate you coming. And hopefully have you on again soon.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.